If you're new here, I'm Paula, and on this channel we break down crypto, macro, geopolitics and regulation. But more importantly, we connect the dots between them. Because crypto doesn't move on its own, it moves inside a financial system. And if you understand the system, you understand the market. Now, today's story on the surface looks dry. It looks bureaucratic, it doesn't scream urgency or drama. The chair of the Financial Conduct Authority has said that despite a ballooning workload, the regulator will not be hiring more staff. That's the headline. No emergency action, no exchange collapse, no new ban. Just a statement that the FCA believes it's now the right size to handle its responsibilities. But sometimes the quiet headlines tell you more than the loud ones. Because when a financial regulator says they don't need to grow further, that tells you something about how it sees risk. And how governments see risk directly shapes how the markets behave. The comment came from Ashley Alder, chair of the Financial Conduct Authority, who explained that after significant headcount growth in recent years, the regulator is now sized appropriately to manage its expanded remit. That phrase, expanded remit, is doing a lot of the heavy lifting here. Over the past few years, the FCA's responsibilities have grown dramatically. Post-Brexit, more regulatory power shifted back to the UK domestically. Crypto asset supervision expanded, anti-money laundering oversight tightened, financial promotions were brought under stricter control. Stablecoin frameworks began forming, the regulator's scope widened, and staffing increased accordingly. Now the message is clear, we are big enough. That raises a serious question. Big enough for what? Is the FCA signalling that the regulatory build-out phase is complete? Is it saying that crypto, fintech and digital assets are no longer a rapidly expanding risk surface, but a managed category inside financial services? Or is this an underestimation of what's still coming? To understand this properly, we need to zoom out. The UK government has repeatedly positioned itself as wanting to become a global crypto hub. But when you examine the actions rather than the slogans, the strategy has not been growth first. It has been control first. The FCA introduced one of the strictest AML registration regimes for crypto firms. Many companies were rejected or withdrew applications. Financial promotion rules were tightened aggressively. Risk warnings became mandatory. Calling off periods were introduced. Refer a friend bonuses were banned. Several exchanges restricted UK marketing or onboarding because compliance requirements became heavier. This was not a race to attract every crypto startup. It was a deliberate attempt to build guardrails first. And now, if the regulator believes it no longer needs to expand its workforce, that suggests those guardrails are installed. That's a structural shift. Regulators expand rapidly when they feel they're behind. They expand when they believe risk is spreading faster than oversight. They expand when something feels uncontained. If hiring has stabilised, that implies confidence. It implies that the FCA believes that the risk surface is mapped and manageable. That matters for crypto. Let's widen the lens further. Across Europe, MiCA is rolling out, creating a unified crypto regulatory framework. In the United States, crypto regulation remains fragmented between agencies and courts. In Singapore, retail access has been tightened after previous cycles of excess. In the UAE, licensing has accelerated in a pro-crypto direction. The UK sits somewhere in the middle. Not hostile, not permissive, highly compliance-driven, institutionally cautious. So when the FCA signals it is sufficiently staffed, it suggests crypto oversight has entered an operational phase rather than an emergency expansion phase. It suggests that digital assets are no longer treated as an external threat, but as a supervised component of the financial system. And that changes market psychology. Early stage industries are chaotic. Late stage industries are integrated. Integration reduces existential risk. but it also changes volatility patterns. When crypto was treated as fringe or dangerous, regulation came in waves of reaction. Now it appears to be settled into steady state supervision. Let's connect this to macro. The UK economy is not in a boom phase. Fiscal space remains tight ahead of the spring statement under Chancellor Rachel Reeves. Growth forecasts are modest. Inflation has cooled but not vanished. The Bank of England remains cautious with monetary policy. In an environment like this, financial stability is critical. If crypto was still perceived as an unpredictable, destabilising force, regulators would likely be scaling resources further. The fact that staffing is stabilising suggests that crypto is no longer seen as a systematic wildfire. It is seen as infrastructure that needs monitoring. Now think about stablecoins. Stablecoins are the bridge between traditional finance and crypto liquidity. If the UK regulates stablecoins under payment and prudential frameworks, requiring back-in and redemption guarantees, they become less speculative and more institutional. That makes banks more comfortable, it makes asset managers more comfortable, it makes integration easier. And if integration becomes easier, regulators move from emergency build-out to maintenance. Maintenance mode is boring, but it is powerful. It means the system is considered stable enough to manage without continuous expansion. It means risk is priced, frameworks are in place, and supervision is structured. There's another angle here that's easy to miss. If workload is increasing but staffing is stable, that suggests efficiency. It suggests automation. RegTech, digital reporting systems, and on-chain monitoring tools are doing more of the heavy lifting. Crypto is, in many ways, more transparent than traditional banking because transactions are recorded on public ledgers. Supervision may actually become more data-driven and less labour-intensive over time. That could be part of the confidence. Now, let's talk about what this means for markets. When regulators panic, volatility rises. When regulators feel in control, volatility compresses structurally over time. That doesn't mean price cycles disappear. It means existential collapse risk reduces. And when existential risk reduces, institutional capital becomes more comfortable entering. Big capital does not enter chaos easily. It enters predictable frameworks. If the UK now views crypto as a contained, supervised asset category, that is long-term constructive. It may not produce explosive, parabolic narratives, but it builds foundations. At the same time, we should ask whether this confidence is justified. Crypto continues to evolve rapidly. Tokenization of real-world assets is accelerating. Stablecoin usage is expanding globally. AI-driven finance is emerging. If complexity increases faster than supervision systems evolve, regulators may need to expand again. But that is not the current signal. The current signal is calm. And calm in regulation is meaningful. It suggests crypto is being absorbed into the financial system rather than fought at the gates. It suggests London wants institutional crypto, not a speculative frenzy. It suggests Britain is positioning itself as a controlled, compliant environment rather than a frontier experiment. For investors, this matters because price exists inside structure. Liquidity, regulation, fiscal policy, and monetary conditions all shape the environment crypto trades within. If regulatory structure is stabilising, that removes one layer of uncertainty. This story is not dramatic, but it is foundational. It hints that the UK believes crypto is no longer an emerging threat, but a managed component of modern finance. And when something moves from threat to category, markets begin to treat it differently. So the real question is this: are we witnessing crypto's transition from outsider to infrastructure? Because if that transition is underway, the next cycle may look different from the last ones. Still volatile, still opportunity rich, but operating inside tighter guardrails. That is the market maturing. And maturing is often quieter than revolution. If you found this breakdown helpful and you appreciate deeper context rather than surface level headlines, make sure you hit like and subscribe. And if you enjoy going even deeper into these macro and structural conversations, join me and Milkshake Matty on the UK Crypto Podcast. New episodes drop every Friday at 7 p.m. UK time, right here on YouTube and on Spotify. Let me know in the comments. Do you think the UK is stabilising crypto regulation or underestimating what is coming next? Thank you so much for watching, and I'll see you in the next one.